All right, welcome back. My name is Kirsten. I am a CPA and accounting instructor, and today we're going to talk about some more financial accounting concepts, starting with our financial statements. So if accounting is the language of business, what are our financial statements? Our financial statements are the story of the business. They're summarizing all this historical information or historical numbers. They're summarizing it, and it's what external users can then read about the company. So you and I can go find financial statements for every single public company and get a general idea of what is going on at the business. So when we think of the financial statements and why we have each of these financial statements, what you should start thinking about is, well, what would you as a user want to know about a company? That is a really good place to start. So what would you want to know about a company? You'd probably want to know things like, how much debt do they have? How much do they have in assets? How much have they made? Are they operating at a loss right now? So you'd want to know some of these things about a business. Those bring us to our 4 financial statements. Our 4 financial statements are the balance sheet, the income statement, the statement of stockholders' equity, and the statement of cash flows. Each of these financial statements will tell a bit of a different piece of the financial story of the business. Let's start with the balance sheet. What does the balance sheet tell us? The balance sheet is going to have 3 types of accounts on it. It's going to have assets, liabilities, and equity. It is what is called a point-in-time statement, meaning every single time you see it, it's going to be presented as of a specific date. So it is a snapshot of what the company currently has. So what are these 3 accounts? What can a company have? Assets are the things that the company has. If you think of your own assets, things like your car, your house, your clothing, those are assets. They're things that you have. Now, when we talk about these things that we have, we're not necessarily concerned with, did we finance them? Do we own them outright? We're just concerned with, what do we have? So on a company's balance sheet, their assets might include things like their inventory, things that they have. It might include software is something that a company can have, maybe a building, maybe equipment that they use for manufacturing. These are all things that the company has. What else is on the balance sheet? Liabilities. Liabilities are the company's debt. So if a company took out a loan, doesn't matter what they did with that money. If they take out a loan, that loan shows up on their balance sheet as this payable account. It shows up as a loan in the liability section. What is our last piece of the balance sheet? Equity. So equity is this residual ownership in the company. Basically, after we pay off all of the loans, after we pay off all of the creditors with our assets, what is left over? That is your equity. Now, a really key piece of accounting is our accounting equation. Our accounting equation is assets equals liabilities plus stockholders' equity. This will always hold true. This equation always has to balance. So on one side, we have assets, the things that we have. Over here on the other side, we have our liabilities and equity. It's basically, what do we have and how did we get the money to buy what we have? Did we finance it with debt, or did we maybe issue common stock? Whatever it is, we have our assets, and then over here we have the claims to our assets. Remember, that equation always has to stay in balance. Now, how does that accounting equation always stay in balance? Well, every single time we have a transaction, it is going to impact at least 2 accounts. So if, let's say, we purchase inventory with, maybe we take out a bank loan to purchase that inventory. Well, our inventory just went up. Our assets went up. Now that bank loan is a liability, so that is also going to go up. So because these have happened on opposite sides of our accounting equation, our equation has stayed in balance. So every single transaction in accounting is going to ensure that that equation stays in balance. Now let's talk about equity real quick. So equity, like I said, it's not quite debt, but what is equity? There are 2 accounts that fall under equity. There's common stock and there's retained earnings. Those are really the big 2, especially if you're in an Accounting 101 class. Common stock is the stock that has been issued to the public. It's been issued to investors. So it's representing this external ownership in the company. Retained earnings is internal ownership. It's all of the earnings that the company has retained over time, hence the name retained earnings. Now, our balance sheet is the financial position of a company at a point in time. We still have 3 other financial statements. Those 3 other financial statements show a period of time. So instead of just showing a snapshot of the company, we're going to see changes throughout the course of maybe a quarter or a year. Now, typically when I talk about financial statements, I tend to talk about companies with a fiscal year beginning on January 1 and ending December 31. That can vary from company to company, but to keep things simple for most of my examples, that's what I'm going to assume. So remember, our 3 other financial statements are our statement of cash flows, our income statement, and our statement of stockholders' equity. All of these financial statements are going to show activity for a period of time. So if we're going to look at an annual income statement, it's going to be all of the income from January 1 to December 31. So let's talk more about our income statement. What does our income statement show? It shows the company's income. So kind of like the name says, it's right there. It's showing what the company has made. So when we look at the income statement, we are going to see revenues and we're going to see expenses. I'll dive more into what's revenue and what are expenses later, but ultimately we're seeing what the company made. Revenue minus expenses is going to get you to net income. If your expenses are greater than your revenues, then you're going to have a net loss. But hopefully, revenues are greater than expenses and you have net income at the end of the period. So what are revenues? Revenues are the amounts that a company has earned. Now, I'll dive into revenue recognition in a later video, but it's the amount that has been recognized by making sales to customers. Typically, there are other types of revenue, but typically we think of revenue as we've made sales to customers, maybe we've done services for customers. It's something that the company has earned and it gets reported as revenue. Now, what are expenses? Typically, our expenses are the costs that the company has incurred in providing those services to customers. So what are the costs that a company has incurred in order to generate revenue? Now, there are also other expenses, but if we just focus on the basics, revenues are these amounts that the company has earned through providing services or selling goods to customers, and the expenses are the amounts incurred in order to provide those services. So when we're talking about revenues and expenses, we are not talking about cash. We are talking about revenues and expenses. They move independently of cash. Cash is important, but it doesn't go into whether something is a revenue or an expense. Now, what is our statement of stockholders' equity? Our statement of stockholders' equity shows changes in, you guessed it, stockholders' equity over a period of time. So if stockholders' equity is primarily made up of common stock and retained earnings, we're going to see changes in those accounts reflected in our statement of stockholders' equity. So what could a change in our statement of stockholders' equity look like? Well, maybe if we're a company and we issue additional common stock, that could be something that would be reflected on our statement of stockholders' equity. Now, what about retained earnings? So earlier I said retained earnings is the amount of earnings that a company has retained over time. So it's this internal source of funding. So when we have our net loss or net income at the end of the period, eventually that will flow through to retained earnings. So retained earnings is going to change in tandem with our net income or net loss. Now, how does it change? Like, how do you decide whether to retain your earnings as a company? Well, with net income, you can basically do one of two things. So once you make all this money, you could pay dividends to your shareholders, or you could reinvest that money back into the business. Typically, high growth companies that we think about, a lot of tech companies, tend to reinvest because they are concerned with growth as a company. So a lot of companies are going to reinvest, but there are some companies like Coca-Cola, for example, that they're not really concerned with coming up with the latest and greatest Coca-Cola product. So really, they're going to pay more regular dividends. Now, while I'm talking about dividends, a really key thing to remember, dividends are not an expense. Dividends will show up on your statement of stockholders' equity, but they aren't going to show up on your income statement because dividends, it's not an expense. So when we think about our net income, at the end of a period, you have a pie. You have all of your net income sitting in this pie. So with that net income, we can choose to move this whole pie, we can reinvest it into our business, or we can take a chunk out of that pie and we can give that chunk of the earnings to our investors. That is dividends. So that brings us to our retained earnings equation. This one is also really important to remember. Our retained earnings equation is beginning retained earnings, so what you opened the books with on January 1, beginning retained earnings plus net income minus dividends declared equals your ending retained earnings. So what you had at the beginning of the year plus your net income, subtract it if it's a net loss, and then subtract your dividends declared. That is going to get you to your ending retained earnings that goes on your balance sheet under stockholders' equity at the end of the period. Now, our last financial statement is our statement of cash flows. As I'm sure you can imagine from how creatively all of these other financial statements are named, our statement of cash flows is going to show the change in cash or cash flow over a period of time. So revenues and expenses, those can be non-cash. They're not necessarily related to cash. They kind of are tied together, but cash is not a part of whether something becomes a revenue or an expense. But if we as investors are concerned about how does this company collect cash, how much cash do they have, well, then we might be concerned with the statement of cash flows, which is really going to show where the cash is flowing. Where's the cash coming in and where's the cash going out? On our statement of cash flows, we have three sections. We have our operating section, our investing section, and our financing section. Now, what's in these three sections? Our operating sections is going to have the cash flows, inflows and outflows associated with the day-to-day operations of the business. Our financing section is going to have our cash flows associated with financing decisions. So that is going to be things like taking out debt, repaying debt, issuing common stock. That's a financing decision. Now, our last section on the statement of cash flows is our investing section, and this one has to do with the sales or purchases of long-term assets or investments. So how do all these financial statements flow together? Well, the first thing we typically prepare is the income statement. We have our revenues minus our expenses, and we get to our net income. Then we use that net income when we prepare our statement of stockholders' equity. So if we remember our equation from before, beginning retained earnings plus net income minus dividends gets us to our ending retained earnings. Then we take that piece, ending retained earnings, and now we can finally prepare our balance sheet where retained earnings is going to show up under our stockholders' equity. Essentially, our change statements are statements that show the changes over a period of time. They're what helps link us from balance sheet to balance sheet. So we have our December 31st year zero balance sheet. We have all of our changes in the middle, our statement of stockholders' equity, our income statement. Now we have our December 31st year one balance sheet. So those statements are what link these two between periods. Now, all of these financial statements show up as a part of a public company's 10K report. That 10K is going to have all 4 financial statements and management discussion and analysis. And if it's a public company, it's going to have that audit opinion. That's it for today's video. So in the next video, we'll talk more about all of these accounts that show up on our financial statements. And as always, if you have any questions or things you'd like for me to cover in more detail, please leave a comment and let me know. I'll see you guys soon.